If the conflict persists and oil prices stay high for an extended period, we must brace for tough times ahead. March was a tough month, but April is likely to be even tougher.
I'm optimistic that during the summer we will see gas with a 3 in front of it sooner rather than later. I'm optimistic that sometime between June 20th and September 20th that we can have $3 gas again.
Hopes that the U.S. and Iran will extend the ceasefire are driving investors back into equities, with several global benchmarks at record highs. But with uncertainty still elevated, we ask whether this rally is getting ahead of itself. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. AI is back in vogue among investors. A failed sneaker company saw its stock surge around 600% after rebranding as an AI infrastructure firm. So is irrational exuberance back? We'll put that question to veteran investor at Yardeni and ask if markets are underpricing the risks from the Iran war. And it's not just equities brushing aside geopolitical risk. China's economy rebounded faster than expected last quarter, but does the stronger data reduce chances of a rate cut? We also examine the supply chain challenges the Iran war poses for India's healthcare sector. Max Healthcare's chairman and managing director joins us with his diagnosis. And we also remember Mark Mobius, the pioneer who put emerging markets on the global investing map, who has died at the age of 89. Our top story today, optimism about the continuation of the peace process between the U.S. and Iran has lifted Wall Street to records. Investors are also piling back into stocks here in Asia, with the Nikkei on track for a fresh closing high. Bloomberg's Avril Hong is here for more. And Avril, does the rally really have legs?
Well, investors seem to think so. I mean, how the conflict and the peace process optimism has continued, allowing investors to focus on the things they were focused on before the conflict broke out, including AI, corporate resilience. You're seeing how the risk premium built up during the war has faded, and a lot of these gauges are at fresh record highs. You think about the TAIEX, the Taiwan market cap has surpassed $4.14 trillion, exceeding that of the UK. This is a market that's been benefiting from revenue growth, but also as its position of an AI hardware proxy. You think about the Nikkei, some idiosyncratic plays today as it hits to that fresh record closing high, including for Tokyo Electron, that's benefiting from sources telling Bloomberg that Elon Musk is telling chip industry suppliers to move at light speed for its Terraform project. But a couple of things to note as well. If you flip the board, you take a look at how on the Nikkei, despite its buoyant performance today, you're actually seeing a couple of other things to consider. With this volatility slipping, you're actually also still seeing the implied volatility, at least on the 1-year contract, the cost of options. That remains elevated. Actually, it hasn't stayed this high for this long since the GFC. So some of our stocks team's colleagues have highlighted that this shows us investors are still paying to hedge for long-term protection, given especially Japan's vulnerabilities to the energy supply shocks. And flip the board again, we've been talking about how the S&P 500 and the Nasdaq hit those fresh record highs. It's worth noting as well how value has outperformed growth so far this year, but we are also seeing growth catching up in April. And as some of our opinion team colleagues have highlighted, the burden of proof is on value. You think about this week, for example, how banking stocks after earnings, the performance in their stocks showed you that maybe they're priced to perfection. So on top of considering whether this rally has legs, it's also about about which sectors are going to perhaps drive this further, Has?
Avril Hong, thank you so much for that. Investors, as Avril said, are piling back into equities on hopes the Iran war ceasefire will be extended. Let's get to Ed Yardeni, president of Yardeni Research. Ed, 7 weeks into the war, I mean, are you seeing through the fog yet? I mean, there's a sense that perhaps investors feel we are closer to the end of the war now.
Yes. Well, it's interesting when you look at the history of geopolitical crises, especially as they affected the S&P 500. History shows that geopolitical crises turn out to be great buying opportunities. So just when everything looks most dire and grim, that's when investors come in and conclude that the war will eventually end and peace will follow. So I think that's the situation we're in right now, as investors are looking past the war, figuring that it's not going to last much longer. They could be wrong about that. Much depends on how the Iranian regime responds to negotiations. Both sides are kind of dug in. The U.S. thinks that we've won, and Iran thinks that they've won, and so nobody's ready to concede much.
Ed, you called the bottom to the market on March 30th. I'm just wondering whether there is a sense that investors are dangerously complacent. I mean, some are saying that the lasting impact of this Iran war is going to be stagflation. Is that being priced in or not?
Right. Well, for a while, there was a concern that the relevant decade that we had to worry about was all of a sudden the 1970s, the stagflation of the 1970s. We had two energy shocks. The second one was, of course, related to the Iranian Revolution. And those energy shocks spread very quickly into other prices and caused a recession. And it wasn't until late in the 70s when Paul Volcker came in that he slammed down the monetary brakes, and then we had a really very severe recession at the tail end of the 1970s. I think that's still a concern. It's still a relevant analogy. But I've actually been talking about the roaring 2020s, the 1920s as an analogy. The economy has been remarkably resilient. I mean, when you think of all the stress tests that the economy has passed since the beginning of the decade, it's really quite impressive that we had the pandemic, the 2-month lockdown in the United States. Then we had the supply chain disruptions, the surge in inflation, the Fed raising interest rates dramatically, little mini banking crisis in 2023, and then tariffs last year. And here we are with real GDP at an all-time record high. It does look like it slowed down in the fourth and the first quarters, but I think a lot of that was actually weather-related. We had some really bad weather, and I think the spring's going to be pretty strong.
So you're expecting resilience doesn't necessarily justify the kind of price action we're seeing in the tech space right now. I mean, we talked about how, that rebranded failed sneaker company, just because it's been rebranded as an AI infra company, it saw a surge of 600%.
Yeah, well, I'm thinking of adding the, AI to the name of Yardeni Research, and see if anybody wants to buy us for skillions of dollars. There is a lot of money out there that's chasing some pretty crazy ideas. So there is an aspect of a bubble to it, but I think one of the reasons that we're seeing AI stocks leading the way here is because with all the stresses of the past several weeks, the AI stocks really just had a correction, and the first, knee-jerk reaction of buying the dip led to the Magnificent Seven outperforming the rest of the market again. So, look, I think AI is here to stay. I think everybody agrees with that. I think the big companies involved in AI are going to be the survivors and going to have the greatest profits. Maybe they'll buy up some of these dinky little companies that rebrand themselves, or maybe they'll just fail. But again, the resilience of the economy really speaks to the fact that our capital markets can absorb a lot of stress without really seeing much downside in economic activity. Look, the private credit situation was already of concern before the war. So if you add the war and what it could do to consumer spending, maybe cause a recession, and then you get private credit concerns, it could have all turned out to end rather badly. But instead, the market started to see that that's not necessarily the case. I mean, banks are still lending. The bank profits that came out this week last week were extremely strong. The bank CEOs like Jamie Dimon said that consumers are in good shape. And by the way, Jamie Dimon has been consistently an alarmist about the economic outlook, and I, with all due respect, consistently wrong. But then again, his stock has gone up, so you can't feel too bad about a bad forecast, but seeing his stock doing so well.
So, Ed, what do you do with AI? What do you do with tech stocks? I mean, you ended your 15-year overweight call on tech recently, and also recently you said that, tech valuations are looking pretty attractive. What do you do? How do you square that?
Yeah, well, I've been promoting the idea of stay home, in other words, overweight the United States, really since 2010. The problem is that it worked out so well that the U.S. got to be 65% of the market capitalization of the MSCI all-country world. And for me to recommend overweighting something that's already uncomfortably overweight, 65%, I mean, yeah, America's got a lot going for it, but, there's definitely opportunities in the rest of the world, particularly in emerging markets. Emerging markets used to do well just when commodity prices went up, and they did very badly when commodity prices went down, because many of them were commodity producers. But now a lot of them have very large middle classes that are very aspirational, want to prosper even more. And so there's tremendous potential demand, not for commodities anymore coming out of emerging markets, but consumer demand domestically in emerging markets, and healthcare demand in emerging markets. And then they all, want to have industrial basis, so the industrial stocks.
Ed, I want to touch on treasuries, 10-year yields at 4.25. Where should it be? Is it still too high currently?
Well, I've been talking about the bond yield likely to trade between 4.25% and 4.75% this year. I don't think we'll get back up to 5% because I think at 4.75% you get lots of buyers. But I'm amazed, really. Here we're going to have a more troublesome inflation environment for the next few months at least, and yet nobody wants to utter the word transitory because it's kind of a jinx based on what happened in 2021 and 2022, when everybody thought it was transitory, and it turned out to be a little bit more persistent than people thought. But bond market seems pretty comfortable to me right here, quite honestly. We've got some bearish factors out there, but on the other hand, the U.S. bond is still viewed as a safe haven, and it's been calm compared to soaring bond yields in Japan or in some European countries like the U.K.
And how about the dollar? It's given up gains since the start of the Iran war. Where do you see the dollar headed?
Nowhere fast. I mean, the beauty of our business is it's not that complicated. Things either go up, down, or sideways. Usually people kind of say there's only two ways, up or down. But it's been going sideways. There's no reason why you shouldn't continue to do that. Foreigners aren't bailing out on buying U.S. equities and debt. Quite the opposite. Last year, they bought something like $700 billion in U.S. equities, all-time record high. And that was the year where everybody was talking about de-dollarization and the, very bearish environment for the dollar. But I think there's no reason why it can't just kind of hold its own right around these current levels.
The dollar just hanging out. Ed, Stan Pat at Yardeni, president of Yardeni Research, is sticking around. We'll be getting his insights on Chinese markets next after the latest data showed China's economic growth rebounded more than expected in the first quarter of the year. Keep it here with us. This is... Welcome back. You're watching Insight. China's economic growth rebounded more than expected in the first quarter of 2026, suggesting limited spillover from the Iran war. For more, our Chief North Asia correspondent Stephen Angle joins us now from Hong Kong. Steve, I mean, we know that the numbers were actually what topped analyst estimates. That's pretty resilient.
Yeah, so resilience is the key here because they've built a lot of their energy resilience into it, the economy and the outlook, and preventing those kind of shocks, unforeseen shocks that are now a reality by, relying a much larger proportion of their energy mix on renewables and also tried and true decades-old reliance on coal and not be as reliant on oil and gas, of course, which has been severely hampered, their imports that go through the Strait of Hormuz because of the war in Iran. So at least in the first quarter, the economy proved to be quite resilient, and also the Chinese continued to rely on that export machine, even though the export growth kind of dipped back a bit in March, where imports were considerably higher. We still saw double-digit gains in export growth in the first quarter of this year. So they're leaning on that. So GDP growth came in above the consensus estimate of 4.8% growth in the first quarter at 5%, which, by the way, is at the high end of their more recently stated goal for the year of between 4.5% to 5%. And it, more significantly, it beat the nadir, the post-COVID nadir that we saw in the fourth quarter of just 4.5% growth.
Steve, any signs of stress at all?
Oh, absolutely. The uncertainty of what's happening in the Middle East is paramount to the Chinese. That's why Xi Jinping is meeting with the foreign minister of Russia, Sergei Lavrov, this week. He's meeting with the Vietnamese new president, who's the party chief there. He's meeting with, just yesterday in the Great Hall of the People, with the Spanish prime minister, Pedro Sanchez. He is rolling out the red carpet to kind of shore up diplomatic relations around the world at a time of great uncertainty geopolitically and on the trade front, and trying to portray China as the reliable partner in a very fractured geopolitical environment. So there are lots of uncertainties. One thing the Chinese are very good at, Haslinda, is sort of building in this resilience and preparing for the worst case scenario. And that's where they're seeing that resilience pay off in the GDP growth. But that's not going to last forever. If the war goes on ad infinitum, all bets are off, and they're going to have to build more resilience in.
Stephen Angle, our Chief North Asia correspondent, thank you so much for that. Ed Yardeni, president of Yardeni, is still with us. Ed, we heard from Steve that, the Chinese economy pretty resilient, but global investors still structurally underweight China. What would force a reallocation?
Well, I think if you look at a long-term chart of Chinese stock prices, 10, 20, 30 years, you'll see that they've basically been going sideways with a lot of volatility. In other words, Chinese stocks have turned out to be great for trading, but they haven't been very good for long-term investors. Even in the technology area, that's been the case with a lot of volatility. Part of it is because of the unpredictability of government policy. Will the government intervene and in business, or will it allow it to seek its own profitability and advancements? And the history of, and even recent history of Chinese government meddling in business has discouraged, I think, long-term investors from really taking a position and staying with it. And so we have obviously also alternatives to investing in Chinese technologies. The U.S. technology companies have done very well, for example.
But do you see real earnings visibility in China? Where might you see that?
Well, I think clearly healthcare is one area, and I think the China 2025 turned out to be quite a successful policy where for a few years, the government's been focusing on certain areas of technological advancement that they've made tremendous progress in. And I think we all know about the AI, we all know about robotics, but they've also invested heavily in biotechnology. And of course, they've got a great market at home as people get older. They do need more health care, more medicines, more hospitals, and more revolutionary drugs. So China is certainly at the forefront.
And you always have to look at China versus India. If a global investor were to add to his EM holding, I'm just wondering whether it would be more towards China or India at this stage.
Yeah, well, last year was obviously a great year for not staying home in the United States, but going global. It took me a little while because I've been in the stay-home camp for so long and it worked so well that it took me until the end of last year to say that I now recommend overweighting the global economy, particularly emerging markets, and particularly emerging markets excluding China, again, because China tends to be a trading vehicle rather than a long-term investment. With regard to India, turned out to be an interesting play here on the Middle East crisis, because obviously high oil prices are not good for India, and now the prospect of peace and lower oil prices are going to help quite a bit. But there's still quite a need for reform. I think the government's made a lot of progress in reforming the economy, but the more the better. And I think there are definitely opportunities in India. But a couple of years ago it had such a big move that it's not exactly a cheap market.
And how about other AI-heavy markets like Taiwan, like Korea? Where do you stand on them?
Well, AI is here to stay. I think AI is not something really that came out of nowhere. It's really part of the digital revolution that started in the mid-1960s with the mainframe, IBM mainframe. The whole idea of the digital revolution is to process as much data as we possibly can, as fast as we can, as cheaply as we can. And AI is certainly continued that revolution in a major way. And obviously the companies and the countries that are most advanced in those areas are going to do very well. So, Taiwan's semiconductors obviously is the market in Taiwan, and Samsung is the market in South Korea, and they should continue to do well.
And as we talk about EMs, we are marking the passing of Mark Mobius. Of course, he's known as the EM guru, a legendary investor.
Right.
Your thoughts on his contribution? Your thoughts on his contribution to EMs and EM investing?
Yeah, well, I think he certainly is one of the giants in the global investment community. And I think he rightly pointed out that investors don't have to stay local, they don't have to stay in developed countries, that there are, in fact, great opportunities in the emerging markets. What was unique about him was that he really, rolled up his sleeves and got into where the opportunities were. It's not easy when you got so many opportunities and also possible disasters to sort them out, but he did an awfully good job of that. And because of his leadership in that, I think we saw that investing in emerging markets has caught on, and it's providing capital for emerging markets to be able to invest in their local economies and prosper. So he's a contributor all around.
Ed, always fantastic to have you on the show. Ed Yardeni, president of Yardeni Research. Still to come on Insight, our exclusive interview with Max Healthcare Institute chairman and managing director Abhay will discuss the company's recent acquisition and the impact of the Iran war on supply chains. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. IMF Managing Director Haslinda Georgieva is warning that markets should be more cautious when it comes to the war in Iran. She told Bloomberg that central banks should resist the urge to hike rates in response to the crisis, as this could damage economic output.
We now have ceasefire. I pray it turns into a durable peace, and in that case, we can see a somewhat faster recovery. But the uncertainty has been profound, and we all need to learn to operate in an environment of high and permanent uncertainty.
But MD, even if there's a ceasefire that stays, okay, and there's some kind of diplomatic resolution, is the market discounting the real impact on the price of oil and therefore inflation?
Well, let me just say that even if the war ends tomorrow, it would take quite some time for the recovery to kick in. Not only because of the infrastructure destruction. Tankers are slow-moving vessels. A tanker that leaves today would take 40 days to reach the Pacific Islands. So we have to keep in mind that the impact is already baked in. Why are markets so optimistic? I think part of the reason is because there is a high concentration of financial assets in the United States. The US economy is doing well. It is relatively not so impacted because the US is an oil exporter, not importer. And that creates that picture of dynamism and vibrancy, but I can tell you that's not the story of the rest of the world. In the rest of the world, already there is a lot of pain.
So, I mean, does that mean that the market is mispricing, that all this market exuberance is actually misplaced?
What it means is that markets are geared by events in the largest economy that are really positive. The United States is the only large economy that has high productivity growth, and markets are seeing that. Technology optimism is here. Markets are rushing on it. But should they be more caution? I would argue yes, because what we are seeing in terms of supply chain disruptions is already quite significant. And with every day that passes, that tanker is not leaving for a destination, and that delays the rebalance of the world economy.
And that was IMF Managing Director Haslinda Georgieva speaking to Bloomberg. And Indian officials say the Iran war could be as disruptive to the economy as the COVID pandemic was 6 years ago. And the damage, they say, could linger for years to come. Bloomberg South Asia EcoGov reporter Anup Roy joins us now. Anup, take us through the implications of that comment.
Yeah, as IMF managing director said, the impact of the market is mispricing the impact, and the Indian authorities are certainly little worried about the impact of the situation, and they think that this could linger on something like COVID period, and they need to take a lot of steps to stabilize the economy.
So what steps are being taken, and what's the likely implications on GDP for the year?
Yeah, so India is, to start with, they are thinking of taking a credit guarantee scheme of 2 to 2.5 trillion rupees that will help the small and medium enterprises, to stay in business and to get loans. So that is the first step. And depending on the situation, the government has chalked out various kind of scenarios. Depending on the situation, the government can bring out one measure after another, and the RBI will also chip in. Like in the COVID pandemic, both RBI and the government had together, given the economy, kind of stimulus, which was 15% of the GDP. So nobody is thinking of that much as of now, but something can come.
Bloomberg's Anup Roy in Mumbai. Thank you so much for that. The blockade of the Strait of Hormuz and escalating Middle East tensions have sent shockwaves through India's healthcare sector. Medical device input costs have surged nearly 50% for critical plastics and over 20% for packaging. That's according to the Association of Indian Medical Device Industry. Joining us exclusively, Abhay, Chairman and Managing Director of Max Healthcare Institute. It operates a chain of hospitals with a major footprint across North India. Good to have you with us. Abhay, take us through the implications of the Iran war for the medical industry.
Well, so we are affected in two manners, essentially. One is global medical tourism. 9% of our revenues are based on medical tourism. But so far, we haven't seen an impact as far as this is concerned. Because we've had some loss of business from the Middle East, but the Central Asian countries, which used to send some patients to the Middle East, now are coming directly to India. I suspect in the medium run, in fact, that perhaps this should possibly play out positively, because a lot of patients from Iraq who were going previously to Iran and so on, and there were some were coming to India as well. We are expecting a lot bigger throughput from Iraq and so on. I think other than this, a lot of... Sorry.
Go ahead, Anup.
So other than this, I think as far as the consumables are concerned, it is local purchases. So those are not effective so far. I mean, I want to keep my fingers pressed, crossed, and hope that there isn't disruption, in sort of weeks to come as well. But we haven't seen a problem as far as supply chain is concerned in the healthcare sector.
So, Abhay, fair to say at this point in time, you're not seeing any implications at all? You're not being hurt in any way at all? And medical tourism is intact?
Yes. So you had loss of patients, like I said, but it's been substituted by patients from Central Asia who were going to the Middle East earlier. So you have more patients coming to India from Central Asia.
No sign of the war ending yet. If the war were to persist through the next several weeks or several months, how might that play out for you then?
So unless you have complete disruption of flights, do keep in mind two things. One is that people don't come to India for aesthetics. People come for for fatal diseases, for transplants, for oncology, and so on. And it's very difficult to kind of put these off. They're coming to India because, they don't have an alternative. It's not as if, for a bypass, for example, cost of a bypass in India is $4,000. And the next closest destination that you have is perhaps Thailand at $20,000. So a lot of people can't make that jump. It's a necessity. People are making their way. I think somewhere the depreciation of the rupee against the dollar is helping as well, is kind of compensating for increase in logistics cost for patients to come into India. So that's kind of compensating, but we haven't seen any major impact on medical tourism so far.
You talked about how you're benefiting from a weak rupee, but a weak rupee doesn't help when you're importing, raw materials priced in USD, though, right? So your import and operational costs should be heading higher.
Well, the assumption is that we're importing our consumables. Our consumables are largely produced in India, and we are using those. Yes, certain branded drugs, medical equipment, but medical equipment is imported intermittently. When you're doing a new project, the LC is already, prices already agreed upon. The LC is already in motion. So we haven't seen any impact as far as that is concerned so far.
How about your growth plans, Anup? We know that in terms of capacity, you want to double that in the next several years. Are you on track?
Absolutely. So we've just launched our new facility in Mumbai, in Delhi, as well as in Mohali, Punjab. These are all three are state-of-the-art facilities and expected to spearhead the government of India's push towards medical tourism. And these facilities are going to be hosting the best of technology as well as Indian clinical talent, which I dare say, the price at which we are sort of we deploy our clinical programs. I think it is needed. It is the need of the hour at present. The cost advantage is something which is required by the world. So I think we feel good about this.
The target is 9,500 beds. Might you do that via acquisitions? Any M&A plans over the next 12, 24 months?
It's 9,500, actually 10,000, and it's already under production. These are the facilities which are being built out. About 1,000 beds have recently been commissioned, which is last month, We're going to be commissioning another 500 beds over the next 6 months. In addition to this, we've also done an acquisition recently in a tier 2 city of Bhubaneswar, which is 250 beds, which we are going to be further expanding by another 500 beds. So that, collectively, it should take our number far beyond 10,000.
And how about your next phase of growth? Would healthcare, diagnostics, digital care be crucial to that?
So, look, we do diagnostics and we do home care as well. It's less than 2% of our revenues at present. It's growing at an increasing clip of about 25% per annum, and it's been doing so for many years now. Having said that, it's still a very small component of our business. It's a required service for our patients to provide pathology services, diagnostic services at home. So we kind of complete our services by doing that. Over a period of time, it's become an attractive business for us, and it's hit the critical mass. But I dare say it's not a very substantive part of our overall business.
How about in terms of AI in your operations? Are you investing in a significant way, in a meaningful way, to position yourself for the future?
So absolutely. I think when it comes to risk stratification of patients, when you're looking at safety of patients, efficiency of operations, and I think in all of these, we've sort of inculcated it as a tool. So far, at the systemic level, we have to be careful. It is healthcare after all. We have 40,000 healthcare workers who work to certain work processes. We have to sort of wait for something to be established out there and then adopt, because it could also be very disruptive. At this stage, it also requires a lot of supervision. So I think rather than jumping onto the wagon and changing all our work processes in order to adopt and have the first mover advantage, I think we'd rather be safe than sorry. So we're waiting for the right technology to sort of get established out there. Because you can't keep changing, you can't keep adopting different technologies at different points of time. So we're waiting for that to be established, and once it's done, I think we'll be well to go.
Is there an investment amount that you're setting aside for AI?
Well, we're not. No, there is no specific investment amount that we are setting aside for AI. It is a part of our digital and AI strategy, which is a couple of percentage points of our revenue, which we typically spend on that.
Abhay, I'm just wondering that as you look to the future and look to growth, what will set you apart? It is a very competitive space. How do you differentiate yourself from your peers?
I think when you look at healthcare in India, it's we had a major change in patient behavior. Previously, everybody I know, for example, was either born in nursing homes or government hospitals. Very few were born used to visit private healthcare. But post-COVID, all of that sort of changed. Now, everybody in India is sort of seeking private healthcare rather than nursing homes and government hospitals, etc. Aspirational India, our idea of public spaces have changed. The metros, the airports, and so on. But the hospitals haven't kind of kept up. The total number of beds in the tertiary care sector in India is less than 100,000 beds, and that's for the entire population of the country. So I think for us, it's very essential today. We have the average age of the population demographics is about 29 years old, but in another 15 to 20 years, we'll be close to the European age. And we just won't have enough beds. So I think it's very important for us to build these beds for the future. That's on one part. On the other side, we also have the global medical tourism. I think the sheer cost and the skill sets that we have in India, we could be catering to the world's healthcare. So I think for us, it's very important to be able to create quality infrastructure, to be able to train medical personnel in order to cater to both these demands.
Abhay, what do you see as the biggest risk for your business? Earlier, we heard from my colleague that the impact from the Iran war will be as drastic as COVID, and that could impact India's growth.
Look, I think it's healthcare eventually, and it is something which is insulated, against inflation, against geopolitics, against economic swings. After all, people, the population is getting older, will need to seek awareness is more. People will seek healthcare solutions. More and more people will seek healthcare solutions and will be seeking a better value proposition. When I look at medical tourism, I think the value proposition comes in terms of better skill sets in India, as well as the pricing that we're able to do it at. And geopolitics, I dare say, would sort of support that. There is going to be, disruption in global economies, supply chains, and so on. And people, by and large, are not going to be economically better off. They'll probably be worse off. And, they will be seeking better value propositions. So I think, Indian healthcare, from that standpoint, should gain from this. I mean, it's unfortunate, but perhaps that's the way we're looking at it.
Abhay, thank you so much for that. Abhay Soy, Chairman and Managing Director of Max Healthcare Institute. India's just joining the trading day and expected to join the rally that we saw on Wall Street and here in Asia. The Sensex index from the get-go up by 0.6%. Recent data showing the country's trade deficit narrowed in March as shipments to and from the Middle East were disrupted by the Iran war. Meanwhile, we're also monitoring Indian banking stocks, which are seeing a solid rebound amid easing concerns over the rupee as well as Indian bonds. Plenty more ahead. Keep it here with us. This is Bloomberg.
The rest of the world is moving in a different direction. I'm talking about the emerging markets world, China, India, Brazil. What's happening in the so-called frontier markets is even more dramatic. The changes in economic growth are going to be quite revealing as we go forward.
You think that emerging markets are at a turning point. Why?
First of all, because they've been so negative for the last 3 years. Emerging markets have underperformed, number one. Number two, India and China are growing at 6-7%.
And what's behind this rally? Is it sustainable going into 2018?
China, of course, because China continues to open up and there's more opportunity there. India would be next, because these are two big liquid possibilities going forward. Even though India has come back a lot and it has even at some point outperformed the U.S. market, India has still got a long way to go. You've got to get used to a whole new order. Some stocks are looking very attractive, and most particularly, countries like India will be benefiting from what's happened with China.
India, disappointed last year. Will it be different in 2026?
I take a longer view about India. India has lots of problems. The bureaucracy is slowing down the economy in many, many ways, but still, despite that, the growth has been tremendous, 6-7% growth.
That was pioneer emerging market investor Mark Mobius, who died here in Singapore at age 89. And from what you saw from my different hairstyles, we've been interviewing him for all these years. Well, Mobius was a visionary and a firm believer in opportunities in emerging markets and made his name at Franklin Templeton, where he worked for more than 3 decades. There, he launched one of the industry's first funds to focus on money-making opportunities in Africa, Asia, Eastern Europe, and Latin America. For more on his legacy, joining us now is Bloomberg M-Live strategist Mark Cranfield here in Singapore, and over in Hong Kong, Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chew. Mark, let's start with you. I mean, Mark Mobius, synonymous with emerging markets. I mean, undeniably the name out there for EMs.
Yeah, and his approach of, he liked to call it kicking the tires. So he liked to go out and see the companies on the ground on a regular basis. As we say in our story, he traveled more than he stayed at home around Asia. And so he knew companies intimately. He would know the structure of the company, the management, the way they were doing business. So he gave him a lot more confidence in holding his convictions when other people were shaking. Even if financial markets were looking a bit dicey, if he really knew those companies from the ground up, he'd be much more inclined to continue to push the story, to stay with the investments, and to hold his view even through times when markets looked a bit turbulent. And that was his real strength. And a lot of people admired his approach to that. It was almost like a Warren Buffett style approach to emerging markets, and that's why he was so successful.
And Stephen, he made the right calls. That's why he had a following. I mean, he called the bull market in 2009. He bought Russian when there was panic in the country. He bought stocks when the Asian Asian financial crisis hit, I mean, he was one to watch.
He's just the EM guru. I mean, not just equities, even FX and fixed income folks like ourselves, we look up to him because we cover EM and he likes Asia, so that's even more relevant. 3 years ago, I had the chance to have a fireside chat with him. He was so bullish on Indian equities, so bullish on Korean equities, Taiwanese equities, and even Chinese equities. And we saw over the last 3 years, all these markets basically rally. But of course, I'm glad I only cover FX, so I was also a long-term bear on the Indian rupee. So I'm glad I don't have to go against him because I don't know about equities, but currencies, like we are bearish on the rupee.
And Mark, you met Mark Mobius yourself. I mean, what was your own takeaway? We know that he loves India. He talks about India being a 50-year rally story.
Yeah, but he tended to be a little early in most markets, whether it was Thailand, even Korea to some extent, Taiwan, Malaysia. India is the classic story. He was way, way ahead of the crowd in terms of India. If you look at when he started to get really bullish in the 2010s, India more than doubled. During the time when he was holding, and he was telling everybody, got to get into India. Most people waited until the market had almost doubled before, so he would have done that very well riding through that. When you go to conferences, I met him a few times there, it was his marketing technique of wearing the very bright suit was brilliant, because you would see loads of people talking about different things, but you'd always remember, hey, that guy in the bright suit, he had this to say. So a clever technique.
And of course, what he said, Stephen, was that, by the time you see the light at the end of the tunnel, it is too late to buy already. I mean, that's something to remember. It's one of the things that, his, left us with, apart from the dozens of books that he actually wrote.
Yes, and the fact that he's so open, like during our fireside chat, like we chat before the event, saying that is there anything that I shouldn't ask, anything that you want to be prepared? He said, no, challenge me. I can answer anything on stage live. Even back then, Market was talking about the cross-strait relationship. He was like, yeah, hit me on Taiwan. I can talk about equities and companies over there as well. He's brilliant, and I took on board his advice when I'm doing TV like now, when I'm doing interviews, doing seminars. Brilliant folk, yeah, an idol. A legend.
Mark, your own takeaway from your interaction with...
Don't challenge him to a weightlifting competition. You're going to lose. I ran into him to the gym one day and he called me over and he said, do you want to join me? And I looked at this bar he was holding and it was so big and I said, no, I think I'll just go and do the treadmill.
And he is a brilliant man. I mean, he got scholarship to learn the Japanese language in Kyoto. I think he had a PhD from MIT. And what I remember is that he did play the piano to help pay for his education. So a man who is really living life. I mean, he lived life and lived life to the fullest.
Definitely, and wanted to get involved in the local culture, the local way things were done, which really gave him an advantage. So he would spend the time on the ground in the countries, get to know how things work, and that gives you a real insight into the thinking of the management of the different companies. So that helps him to build a stronger base here of, okay, I really like this company because these various reasons, and you can hold that conviction even when things are moving around.
And from what I know, he flew 300 days in a year. Wow. Well, Mark Mobius, we will miss you. And that was Bloomberg MLive strategist Mark Cranfield and Bloomberg Intelligence Chief Asia FX and rate strategist Stephen Chu. That is it for Inside. Horizons Middle East and Africa is next. This is Bloomberg.